Hello and welcome to Spark. I'm Wendy Huang and I work in the primary markets team at the London Stock Exchange. My role is to provide guidance to companies and investment funds in the Americas on listing in London, and I myself am based in New York. I'm excited to moderate this panel today on life after IPO, navigating the governance and reporting requirements as a newly listed PLC. Now, London's capital markets can cater to companies across a broad range of sizes, growth objectives, and funding needs. Our growth market AIM is the most active growth market in Europe and can support smaller companies to IPO at an earlier stage of growth. So many companies going through their IPO journeys in London may be setting up boards for the very first time and having to work through governance and reporting requirements for the first time. Today, we will cover some of the common topics facing newly listed boards and how to navigate them. I'm delighted to be joined today by Rosie Hooper, Director at Board Intelligence, Paul Johnston, the Associate Director at One Advisory in the company Secretarial, Governance and Compliance team, and Jaz Marwaha, the Associate Director at One Advisory in the Financial Reporting and Transactional Support team. A very warm welcome to you and many thanks for joining the panel today. This session is being recorded, and if anyone wants to revisit the content or share with any colleagues, can do so by revisiting the Spark page, where this webinar will be made available as a video on demand going forward. This is designed to be an interactive session, so we do encourage you to ask any questions using the functionality built into the platform. You will see the Ask a Question option on the top right-hand side of your screen. The questions will come to me, and I will present them to the panel during the Q&A section at the end. Our panelists will now each give a brief introduction of their company and role, and then we will jump into the panel discussion. Let's please start with Rosie Hooper at Board Intelligence, please.
Thanks, Wendy. Hi, everyone, and lovely to meet you virtually. So as Wendy said, I'm Rosie Hooper, and I'll just start by giving you a brief overview of Board Intelligence and then a quick background to myself as well. So at Board Intelligence, you may have heard of us. For years, our remit was very much quite a narrow one. It was all about how can we help boards to operate at full pelt. So what this really meant was helping them to have the conversations that really matter and the information flows to support that. Because we all know that no matter how smart people are around a boardroom table, they are only as good as the information that they're supplied with. But very often, the information that goes to a board is often described as an obstacle. It's not often, a real asset. We like to say that actually it should be providing 20/20 clarity when actually it tends to provide more fog in the room. And what we've seen over the years is actually there are three good things that come out of what makes good quality information. And this we bottled into what we call the QDI principle, or question-driven insight. Now, these three things are, first of all, focus. Is the board pack focused on what really matters, or is it down in the weeds? The second part is all about critical thinking. Does every paper display critical thinking? Do they tackle the tough questions in a really comprehensive way and provide actionable insight? And the third part is all about great communication. Is every paper in the board pack well communicated? Is it clear, concise? Is it compelling? Now, what we've also learned over the years is actually, if any one of these three things is missing from the board, it's actually often missing from management meetings as well. And over the years, what we've now done is spent more of our time working with management and working throughout organizations as well as with boards. And what we've also learned is that actually, if you use technology to deploy this QDI methodology throughout organizations, it can have a huge impact. Not only the quality of the reports that are being produced, because actually it goes down to producing a set of skills that pays dividends far beyond the boardroom. And that can be really beneficial in a post-IPO environment. As a bit about me, I've been working at Board Intelligence for the past 8 years, working with our clients across all sectors to deploy this QDI principle. And I firmly believe that if you can get your internal reporting right, it can have significant benefits.
Thanks, Rosie. Paul, could we now turn to you, please, to introduce One Advisory and your role?
Yeah, of course. Hi, everyone. I'm Paul Johnston. I'm an Associate Director at One Advisory. And first of all, a big thank you to the London Stock Exchange and the Marketplace team for inviting us to participate in this webinar. So to introduce One Advisory, we're a professional services firm based in the City of London, and we're split broadly into 3 business lines. So the first is the financial reporting and finance function. So that's Jaz's team. So Jaz will talk in more detail about that particular function. The second is the team that I'm involved with, which is the corporate governance and compliance and company secretarial services team. And then the third line is transaction specific project management. So that can be something around pre-IPO services, that can be to do with your corporate reporting, and those kind of things. So we'll no doubt come on to some of those in a bit more detail. So since being with One Advisory, just to explain, I've been with One Advisory for just over 2 years now, and I've been involved with a number of IPOs. And I think One Advisory, I think the key thing that we see as our differentiator is the fact that we play that supportive and advisory role, both pre-IPO and post-IPO. So we provide a degree of continuity, in my case, as the company secretary, throughout the IPO process. And we aim to be a trusted advisor throughout that process and build that trust and confidence. And that very much chimes with the company secretarial profession in general, where we're trying to establish ourselves as trusted advisors to boards and to companies. So one, we leverage on our experience in supporting clients establish corporate governance frameworks that are appropriate for the board and the company in the current stage of development. And I think it's important to emphasize from the off that we really don't believe in a one-size-fits-all approach towards corporate governance. So what might be appropriate for an established premium list company may not be appropriate for a newly listed company on AIM, for example. However, we do see some hallmarks of what we might term as good corporate governance. And we encourage our clients to adopt these as they continue their journey post-IPO. And one of those hallmarks is around high-quality board reporting, and for that reason, we're really pleased to have Rosie from Board Intelligence join us on this webinar. So to introduce myself, I'm a chartered corporate governance professional. We were formerly known as company secretaries, and I've been doing that role for a scary amount of time. It's actually more than 15 years now. And I work in professional services, but prior to that, I was working in government and charity. So I have seen corporate governance frameworks in a number of different scenarios, and that really confirms my belief that there is no one-size-fits-all approach. So yeah, really looking forward to the webinar, and I'll leave it there for now.
Thanks, Paul. Let's now turn to Jazz, please.
Hi, everyone. Thanks for taking the time to join us here today. Just following on from Paul, and to give some more depth on One Advisory, our background is from the public markets. We're PLC focused. 90% of our 120 or so clients are listed on London's main market or AIM. Our primary mission is to provide and help support London's listed PLCs on their journey to becoming a PLC. Whilst Paul's team will help navigate companies through the governance regulations, my team will help guide companies on the financial reporting requirements as a PLC. We look to also take a lead project management role on the company's IPO journey and can advise on significant corporate transactions. The benefit of this, to allow the management team to focus on what they're good at in their business and to get a certain level of comfort. The majority of our work is referred to by some of the city's leading advisors that we work closely with over the last 25 years, be it investment banks, nomads, or reporting accountants, and it's what sets us apart. Having guided many companies through their journey to IPO, from my experience, it's those first few steps post-IPO in which the company could do with some additional guidance. And that's why I'm looking forward to being involved in this webinar today. And hopefully those that are watching can take away and be aware of some of the pitfalls that have tripped other companies up in the past. And just quickly on me, I'm a qualified accountant, and I've been working at One Advisory for 3 years now. I specialize in helping companies prepare for their listing on the London Stock Exchange. And my work is split between pre-IPO financial work streams, and that would include IFRS conversions and FBB memos, and post-IPO work streams, whereby I advise clients on other significant corporate transactions, such as share-based payment valuations, PPAs, and I tend to guide them through their reporting cycle.
Thanks, Shaz. Perhaps let's kick off the panel now with what you said in your introduction to set the stage a little bit. You mentioned that post-IPO, you feel that companies could benefit from additional guidance. Could you please build on that a little bit?
Certainly. And I think it's helpful if we actually take a step back to give an overview of the environment just prior to IPO. On the run-up to IPO, the company will be surrounded by many advisors, reporting accountants, nomads, lawyers, all guiding them step by step on this journey. And the day finally comes, the bell has rung on the London Stock Exchange, and the company is listed. But following that, the advisors who were guiding the company down this route now disperse, and the onus now falls on the company to navigate those first few steps. If you research articles on IPO, 99% of them will detail what to do on your journey to IPO, but rarely do you see an article that details the immediate journey after it, which hopefully we can help you with today.
Fantastic. So now let's start from go back to the beginning a little bit. How would you describe the typical environment of a company in the run-up to an IPO? Paul, perhaps let's turn to you for this one.
Yeah, I think the reality of it is that typically the pre-IPO environment, particularly in the sort of the crunch phase, can be quite frenetic, and I think there's a huge amount of focus on the IPO itself, and quite often the process works to very demanding timelines. So I think that there is that drives a real focus on meeting the various requirements of an IPO. Both in terms of hitting the various milestones, but also in terms of developing the required documentation. So I think the reality of IPOs is that the advisors that you have in place, that a company will have in place, are all very focused on the IPO. And management time can be split either between feeding the IPO beast to some extent, but also running the business. So there is a real demand on management time, and I think that's one reality of the pre-IPO environment. The other thing is that quite often the boards that will be in place post-IPO often only come together fairly shortly before the IPO process. This isn't universally the case, but quite often boards will only formally come together and be appointed shortly prior to the IPO process. And I think that those two things mean that, at least from a corporate governance perspective, while there is a huge amount of documentation and there is a huge amount of work that goes into building the corporate governance framework, the reality of those demands on time and the time pressures of the IPO mean that it's often only after the IPO process that the corporate governance framework that's often set out very neatly in the documents can really bed down. So that's definitely been our experience over the last few years when it comes to pre-IPO.
And Jazz, would it be fair to say that the same environment outlined by Paul extends to those charged with the financial reporting commitments of the company?
Yeah, definitely. I think, as Paul alluded to, this need to bed down frameworks applies to the new financial procedures that were established part of the IPO process, with an emphasis on the financial position and prospect procedures report, commonly referred to as the FPPP report. For those that are watching that have yet to undertake the IPO process, the FPPP report is a vital part of the IPO process, whether the company intends to be listed on the main market or AIM. It details appropriate procedures to be in place for reporting the company's financial position and prospects at the time of IPO. Now, typically at the date of IPO, there will be a handful of FPPP policies that have been documented but not yet implemented, be it because it was agreed that they were going to be implemented from the day of the IPO, or it's possible that some of these policies were even going to be implemented within 3 months post-IPO. So one piece of advice I'd like to put forward early on is to review your FPPP document regularly, and certainly within the first few weeks, to ensure that there is a clear and concise plan to implement those policies outstanding. There's a reason that these policies were put in place. It wasn't a box-ticking exercise, and you don't want to get caught out later down the road when you haven't implemented these.
Thanks, Shaz. And let's go back to Paul for a bit. So based on what you said, how do things then change in the new post-IPO landscape?
Yeah, I mean, this is a huge question, so I'll try and remain fairly focused on the key points. But I think there's absolutely no question that the IPO is a massive achievement. But in some ways, the work really begins from the moment of IPO. So, for example, there'll often be a relatively new board in place. There'll be new board committees. There will be, as Jazz has outlined, there will be documents that set out the delegations of authority between the board, the committees, and management. And all of these can result in a new way of working for management and staff, as well as the board. And it's important to remember that with IPOs, quite often we have companies that have been around for quite a long time, and they're having to adjust to a fairly new way of working, whether it be with non-executive directors, whether it be with new committees and these kind of things. So how all of these operate in practice does tend to be considered post-IPO. So is that framework of delegated authorities really understood by the board and by management? Is that really understood by the non-executive directors and the executive directors? And does the board have a common view of its role across all directors, and then the process is really in place to support that role being carried out? And I think one of the other aspects to the post-IPO environment is that you inherently have a wider range of stakeholders. So you will have, if nothing else, you'll often for the first time you'll have institutional investors as one of your stakeholders. There's more emphasis on considering the role of regulators, of government. With the ESG agenda, there's more focus on the role of communities and the environment, for example. So has the board really got a common understanding of who your stakeholders are? Are the additional legal and regulatory obligations that you're subject to post-IPO, for example, market abuse regulation, are they really well understood? And all of these things really can't be underestimated, and they demand, and I think this is something that we're just going to keep on coming back to throughout this webinar, is they really demand conversations. And from a board's point of view, they demand time on the board agenda and on the board committee agenda.
Completely understand, Paul. Just more different people to answer to. So given this new post-IPO environment then, Rosie, what would you say organizations should be focusing on?
Yeah, it's a great question, Wendy. And I think as Paul just explained, it is a big period of change for organizations post-IPO, and it can be really hard to know what to focus on. So I think from our experience, it's all about getting your board absolutely humming. And if you start there, then it's always a great place to start. So asking yourself questions like, how do we make sure our board are operating as a really coherent team? As Paul touched on earlier, sometimes these boards are quite newly formed in the run up to an IPO. They might not have ever met in person. It might only have been virtual. So how can you make sure they really are operating as a team? How can they best support management? How can they make sure that they are fully up to speed from day one, giving the oversight that they really need to make sure that they can start to discharge their duties and do their jobs well? And, all of these are quite big questions to answer. And I completely agree with what Paul said. It's all about getting time on board agendas and time on in having these proper conversations to make sure that you can bottom some of these things out.
Thanks, Rosie. So what is the secret sauce here then?
Well, it's exactly that. So I think, from our experience of working with sort of over 35,000 leaders, over 3,000 organizations, it is all about getting the board conversations absolutely right. And if you do get them right, it's not just about fulfilling your legal obligations. It's all about making sure your board is actually set up to fly. And there are two things really that we like to think about when it comes to making sure your board conversations are set up to success. The first is all around making sure that the time that the board has together is absolutely focused on what matters. So it's not just about the things that you have to be discussing, but also really importantly, the things that you want to be discussing. And then secondly, the information that you have to support that. So how do you make sure that actually you're getting high quality reports that really address the questions that are on the mind of your board to help them to have those conversations?
Okay, perfect. Thank you.
If I can just chip in there, Wendy. I mean, I completely agree that the emphasis on conversation and dialogue on the clarity of roles and responsibilities is absolutely fundamental. And I think one trap, if you like, that companies can fall into or boards can fall into immediately post IPOs, that they can regard having this board, having the new non-executive directors in place as something of a compliance exercise, and there is, as I'll come on to later, there is for sure when it comes to corporate governance, there is a compliance aspect, but there's also a huge opportunity when with the non-executive directors you have in place, if you really utilize them well, to turn what can be a compliance exercise into something that's really a value add and something that's focused on the long term and is focused on strategy and operations. So I think as much as anything, it's partly around mindset as much as anything else in terms of how you utilize the board post IPO.
Great. Thanks for that insight. Let's take a turn to the financial reporting front for a moment. Jazz, what are the reporting and disclosure obligations companies and boards need to be aware of post-IPO?
Yeah, well, the first main change to the company's financial reporting timetable will be the requirement to prepare interim financial statements, which will be for 6 months from the end date of the historical financial information that was included in the admission document. Now, in addition to this additional reporting requirement, does come a much tighter reporting timetable to be aware of. The interims need to be disclosed to the market 3 months following the period end, and the year-end numbers need to be disclosed to the market within 4 months post-year-end if listed on the main market, or 6 months post-year if on AIM. So whereas previously the company may have been focused on the company's house deadline, they now need to ensure that they have the resources in place to turn around the numbers in a timely, accurate fashion and provide them to the auditors and give them sufficient time to review and audit. And if we go back to the interim financial statements, a question I get asked a lot is whether they need to be audited. They do not need to be audited, but given that these will be the first set of numbers presented to the market, I would highly recommend engaging with the auditors to undertake a review of the numbers, just to de-risk yourselves. Additionally, I would consider the transactions that have occurred in the period. Would it be worth seeking additional support and recording those transactions prior to getting the numbers reviewed by the auditors? The company does not want to be in a position whereby they push out unaudited, unreviewed numbers, and come year end, when they are being audited, they drastically change due to an accounting oversight, be it incorrect option valuations or an IFRS 16 lease impact that was not accounted for. So what is the takeaway from this? Do not underestimate the time it takes from the start of preparation of the interim and the year-end financial statements to being able to present those results to the market. The accounting disclosures are much more rigorous. Not only is this due to reporting under IFRS, but the accounts are now subject to a quality partner review and technical review. The emphasis is the time taken to get a set of PLC accounts through audit is much longer than a limited company. From a high level, you may think the company is exactly the same, revenue mix hasn't changed, no significant change to overheads, but from a disclosure and audit perspective, the timing will be longer.
Completely agree. We often see bottlenecks in the auditing process on our side as well. So Jazz, what are some of the examples of potential pitfalls and consequences then when it comes to reporting?
Yeah, I would say the number one pitfall is being unaware of the accounting consequences of certain financial or equity instruments and arrangements that have been entered into, and the potential knock-on effect. Being unaware of the accounting consequences can have an impact not just on the numbers, but also the timelines to deliver those numbers. Now, practically, what do I mean by this? Let's look at an example, and I'm sure maybe we've got some finance directors here. Let's take share options. Something many companies issue both pre-IPO and post-IPO are familiar with. And to stress, this example also applies to companies that have historically granted share options pre-IPO who can also get caught out with this. So you as a company grant share options to all directors on the date of IPO. And with the company now listed, the performance conditions attached to those options is directly related to the share price. If the share price is X pounds, the conditions are met and the options can be exercised. So far, so good. And for those that have accounted for share options before are probably aware the company are required to recognize a share-based payment in their books at fair value using a valuation model. Now, here's where things can get interesting. Prior to listing, the company may have issued simple options whereby there is a fixed exercise price, there are no conditions attached to the option, and it can only be exercised at one fixed point in time. Calculating the charge is relatively simple. But if the company have now issued options with market-based conditions, like I described above with share price targets, they are now required to use a much more complex model, such as the Monte Carlo model, to value these options, something that would typically have to be outsourced and is a much more time-extensive exercise. And this all comes back to the original point of time. Make sure you are aware of the reporting implications of the financial and equity instruments you have, and ensure that you plan enough time to ensure all work streams can be met before the deadlines. That means reviewing option agreements, convertible loan agreements, consider all the significant transactions that have occurred and ensure you have a firm understanding of the impact they will have on the financial statements, so there are no surprises at the interims or year end. If on review you are still unsure, reach out to an external advisor like One Advisory to get those significant transactions or agreements reviewed, and they would be able to advise you on the impact on them.
Okay, so to summarize, I guess the advice would be the earlier the better when it comes to preparing financial statements.
100%. The earlier the better. The above review I just touched upon, whereby the company should review any major transactions or agreements that occurred between IPO and the first interims, should be built into the overall timetable. As a PLC company, it is now too simplistic to say we want to announce on X date, and when working backwards to calculate the timeline, assume that the preparation time will be in line with how long it took historically to prepare those numbers. And touching upon the agreements, should you be thinking about entering into a significant transaction, maybe issuing share options, convertible loan note, there is absolutely no harm to have that agreement reviewed by a financial reporting advisor before signing it, because the wording of the agreement could have major implications on the numbers, whereby the tweaking of certain language can lead to a much more advantageous outcome from a financial reporting perspective, whilst still giving the same tangible outcome of what the agreement was trying to achieve.
Thank you, Jazz. It's super helpful. Now let's turn back to the board conversations. It sounds like the board pack is vital to the board operating effectively. So Rosie, what is the impact of not getting this right?
Yeah, I think it absolutely is, Wendy. And it sounds really obvious to get your board papers, right, but it's actually really hard to do. If I share some statistics with you based on some research that we've done with the Corporate Governance Institute over the last 5 years, actually it paints a pretty bleak picture. We've had over 800 respondents from organizations of all different sizes, all different sectors, different ownership types, all sorts. And what we found is that over 80% say that their board packs are weak or poor, and that 72% say that their board packs are an obstacle or of no help at all to their board conversations. And I think that's really quite shocking. And if you start to lift the lid on this and think, actually, what is it that's underneath that? Why is that the case? Well, 69% say that often their board packs are far too operational. And from our experience, this is often at the expense of strategy. Boards want to be talking more about strategy and the forward view. 66%, so 2/3, are saying that actually it's like finding the key messages, like finding a needle in a haystack. It's really hard to know what it is that you're supposed to be taking away from that board pack. And we've seen it with the length of packs and the length of papers that I'm sure you've all received. And 61% say that their board packs are far too introspective and don't take enough view looking at the external world or the external market. And what's quite fascinating is actually this is getting worse. So 3 years ago, we found that 50% of boards were indeed getting something out of their board papers, but now it's only a quarter. But it's not all doom and gloom. And I think that's why I want to share some of these stats today, is that actually all of you on the line, if you are looking at IPOing or in a post-IPO world, you're in a really rather unique position. You've got this great opportunity, almost with a blank sheet of paper, to get this right and to avoid some of the common pitfalls that we so commonly see.
Right. And beyond the board pack, what are some of the other challenges that boards may face? Paul, what are your thoughts?
Yeah, there are a huge amount of challenges potentially that boards can face, and I think but I'll just touch on 3. I think the first is that there can often we've already talked about the boards coming together shortly before the IPO, and there can often be a diversity of range of experience and perspectives on the board that come together post IPO, and I think that can sometimes result in some sort of divergence on the views of strategy, and in some cases at different levels of understanding about some of the strategic drivers in the business and the industry in which the business operates, and that can in practice result in some degree of tension sometimes between executives who have been rooted in the business for quite often some time and non-executives who have come on more recently. And I think to touch on the points that have already been made, it's really about making sure that there's enough time on the board agenda to really get that clarity of view on strategy. So, for example, one of the things that we often recommend to our clients immediately post IPO, or certainly in the first 12 months, is to have a proper strategy, proper session on strategy to really look at some of the short-term drivers, the long-term drivers. And ultimately, the board should be able to answer the question, what does success look like for our business, fairly consistently? If there's a divergence of views on that, that can hint at some sort of dysfunction on boards, to be frank. So that's definitely one issue. The second can be a divergence of view on the role of the board and of the board committees itself. and where the role of non-executive should begin and end. We have seen instances in the past where non-executives have been certainly perceived, at least, as being too hands-on, and that can certainly be a sensible position for boards to adopt in the first 12 months post-IPO. And it can certainly be a sensible approach. We certainly saw during COVID that boards met more frequently, and that was a sensible and proportionate response to what was quite a unique situation. But what can be established, as Rosie has touched upon, this is an opportunity post-IPO, and if boards are meeting too frequently, if their focus is too operational, that can end up becoming part of a long-lasting dynamic, and eventually that does, as I say, breed some sort of tension. Likewise, with the remuneration committee, do they have a real clarity on the view of the company's policy toward remuneration? Do they understand what incentivizes their executives and what the comparable benchmarks are in the market? Or is that, again, part of the learning journey? And similarly, audit committee, do they really understand the principal risks facing the business post-IPO? And these are all sort of, they can be perceived as hygiene factors, but they are all important in terms of delivery of the strategy. Similarly, I think boards really need to be able to factor in stakeholder expectations. So we won't touch upon this on this webinar, but ESG is obviously a massive driver for many PLCs. And the board needs to have a view on its approach toward ESG, where its risks, where its opportunities. So again, I think that's around conversations. And then the third is building the team. So one development from COVID was that obviously everything went online. Board meetings happened online. That was good in some ways. It meant that we didn't get to travel as much, which was bad in some ways. But nonetheless, that does take away the opportunity to really build teams. And I think one of the key dysfunctions of boards can be around trust. And these sessions of informal trust building sessions are really important toward boards, because ultimately part of it is around, part of the role of the board is to provide constructive challenge. And that can be perceived in the wrong way. It can be taken in the wrong way if that trust isn't there. So I think one of the things that we really recommend that our client boards do is take the time to find ways of informally getting to know each other, getting to understand each other's perspectives, each other's preferred ways of working. And I think that that's a really important way of starting off on the right foot post-IPO.
Thanks, Paul. So we've talked about the importance of getting the board conversations right for the board to operate effectively and to avoid some of the pitfalls that we just touched on. So, Rosie, you mentioned that there are two parts to this. One, focus your time on what matters most through the agendas, and two, to frame the board conversations with high quality insight through the papers. Can you elaborate on the first, please? Just focusing on your time on what matters most. Like, how can that practically be done?
Yeah, it's a good question. How you can focus your time on what matters most is quite a big question. So perhaps if I share an analogy that might bring it to life, and this is from a guy called Stephen Covey, who is the author of 7 Habits of Highly Effective People. And he actually used this analogy when it comes to people thinking about how they prioritize time in their personal life. But we find it works equally well for boards and board agendas and how you prioritize time for those. So it's called the jar of life analogy, and some of you may have heard of this. And essentially, it starts on the premise that the amount of time that boards have to discuss and to meet over the course of a year is finite. And that is symbolized or represented by an empty glass jar. Now, in that jar, you could fill it with all sorts of things, but there are 3 main things that actually you're going to use to fill that jar. The first is what we call rocks. So these are the priority items that that board or that forum needs to debate or decide upon over the course of that next year. The second are what we think about as the pebbles. So these are those really important, urgent items that you never going to crop up, but you just don't know what they are ahead of time. So it could be someone wants a deep dive on X, or something's happened in the external market that suddenly needs to be discussed. As I say, you don't know what they are, but you know they're going to crop up. And the third and final thing you could fill your jar with is sand. And this represents all the routine, regular items that you absolutely need to be discussing over the course of the year. Now, what we tend to find is that when we look at board agendas, they tend to be absolutely crammed full, and it becomes impossible to fit anything else onto them. And that's because sort of what's happened is that jar has almost been filled with the sand first. And if you fill a glass jar with sand, it gets filled to the top and there's no space for anything else. So what do we actually recommend you do? Well, if you take your empty glass jar, start by filling it with the rocks. Put in there the key items that that board or that forum needs to discuss or debate over the course of the year. That means there's definitely space for them. Then add in your sand. Those are your routine, regular items that you definitely need to be discussing. And if you sort of shake it, so to speak, you'll find that the sand fills in between the rocks and there's plenty of space for that too. But the key to this analogy is making sure that you only ever fill your jar up to 80% full. And that means you always leave space for the pebbles that you know are going to come at some point, those urgent, important things, but you just don't know what they are. So it means you leave space for them too. So the result of this means you end up with agendas that are really led by the priorities of the organization, but there's also sufficient time for everything else that you need to be discussing. And if we go back to a point that I touched on earlier, and I know Paul's mentioned it as well, you are really at a unique opportunity here to set your boards and to set your forums off to succeed. And actually by running this exercise and doing it, you can almost imagine a kind of glass jar for every meeting throughout the course of the year. If you do this at the start, it can really help to set you off on the right foot.
Thanks, Rosie. I think that's a great analogy and a great visual that I had in my mind of a jar as well. So, getting agendas focused on the right topics at the right time is obviously critical to board effectiveness. So, Paul, how would you advise organizations that have just IPO'd ensure that they're covering all of the necessary governance topics at the right time?
Yeah, thank you. It's an important question, and I think I'm probably going to try and answer it in two ways. I mean, the first is around, and these are very broad terms, but the first is around what you might call compliance. And the second is around corporate governance. So these are very sort of crude, broad terms, but I think it probably will help sort of frame the answer. So I think in terms of compliance, if you like, what we at One Advisory do for our clients is that we put together what we call corporate calendars that look across the next 12, sometimes 18 months, looking at all the key compliance milestones that you have to hit throughout the year. And these can be some of the things that Jazz has already mentioned: full year results, interim results. When do you have to have your AGM? When should you start thinking about what's actually on the AGM notice? What's the format of the AGM? How much do you want to engage your shareholders at AGMs? These kind of things. And this can all be mapped out. So I was hosting a seminar earlier this year, and one of the people on the panel said that the role of the company secretary is to be the most organized person in the room. And I think one of the key things for us is to develop this annual cycle. And I think this is particularly important for a company in the first 1 or 2 years as a listed company. One of the things that we really want to do for all our sort of collective well-being, if nothing else, is to eliminate surprises. And by and large, these annual compliance events can be planned in advance, and it is possible to avoid surprises and therefore avoid risk. So that's what I might talk about when I think about compliance. However, there's also a corporate governance, which is about ensuring the widest part of effective corporate governance, as far as I've seen on boards over the last 10, 15 years, is about ensuring the widest range of inputs. So how does the board hear from its employees? How does it hear from its customers and its other key stakeholders? And this is embedded in company law under Section 172 of the Companies Act. And are we getting the balance right? And part of Section 172 also is about, are we getting the balance right between the short term and the long term? And these are consistent questions that I think boards should be asking themselves. So we really do encourage boards to have ways of getting different sources of information. So that can be different members of the senior management team can attend meetings. It can be different formats of reports. Staff survey findings can often be a really interesting barometer for how staff are feeling, for example. But I think corporate governance is really, if the board is really doing its role really effectively, it does have that really wide range of inputs, and that's particularly important as a PLC. The other slight bugbear I have around the way corporate governance can be described is it can be described as a tick box exercise. And I think that is correct in some respects. So when you think about compliance, you have to have an AGM, you have to produce full year results, you have to produce an annual report. These are all boxes that you can tick. But to regard everything around corporate governance as a tick box exercise, I think is a really wasted opportunity. And I would again encourage those on the call to really think about how you can utilize your board to maximize value. So for example, one of the interesting developments with the most recent iteration of the corporate governance code was a real focus on culture. And some boards sort of shied away from this, and they said, this isn't quite a verbatim quote, but it almost is that they said, we don't want to talk about culture just because the regulator tells us to. But this is probably the wrong perspective. This is probably the wrong way of looking at it. If you talk about culture in a meaningful way, that can really be a long-term differentiator. It can really be a generator of long-term value. So I think personally, I think it's really important that board talks about culture. So I think it's really important, as I think Rosie's analogy is a really good one, and I think it is really important that you map out as much as you can throughout the year and get that balance between what you might call compliance items and governance items really correct and fit for purpose and right for the board of the company.
Thanks, Paul. Rosie, you had also mentioned, providing boards with high quality information and the insight that they need. How do you advise doing this?
Yes, I've spoken to lots of CEOs, CFOs, chairs, governance professionals, directors over the years who have all been absolutely adamant that they really want to change the quality of their papers, but at a loss of where to start. So lots of organizations, I'm sure some of you on the line might have done this, start by introducing a template. But the challenge with that is that often people don't use it, or they use the wrong one, or one template is not a one size fits all. It doesn't necessarily work for every type of paper. So it requires lots of policing, lots of energy, lots of effort, which tends to dissipate over time, and you lose the impact that you're looking for. Back in the day, I used to do lots of training for execs and senior management teams on how to write a good board report. And they were always some of my favorite sessions because everybody would turn up, typically looking really unenthused at the thought of spending the next few hours talking about their least favorite topic, which would be reporting. And I loved it because they'd nearly always leave feeling, a lot more excited about the next paper they've got to write. And that was mostly down to the fact that they actually understood the value to them and the value to the business in getting it right. But however great training sessions are, we know they aren't a golden bullet. I think we've all attended workshops, I'm sure everyone can relate to this, where you've gone and you've left feeling really enthused and really inspired, but 3, 6, 9 months later, you can barely remember 1 or 2 of the takeaways from the session. We're all human, we all get caught up in the cut and thrust of the day to day, and actually these things don't always stick. So to answer your question, Wendy, kind of how do you go about creating high quality reports that's really embedded for the long term? I think it's probably a combination of all of the above. So I think it is a combination of introducing not just a template, but a combination of templates that really support the different types of papers that your different colleagues are going to have to be writing at different courses throughout the year. There is an element absolutely about training to make sure everyone's up to speed on how to use those templates, how to write a good report. And a big part of that is, I think, the third element, which is all around kind of bringing hearts and minds and bringing people along with you on the journey. But I think there's a fourth element that we found as well, and I touched on at the start, around technology and how you can use technology today to really embed this throughout an organization. So we have a tool called Lucia that does exactly that. It kind of captures all of those points above. And we found that actually it's been a really powerful way to not only drive the change and make sure your reports are of a much higher quality, but embed it for the long term as well.
Great. And what would be the impact of getting this right?
I think it would be really great to be able to say that there is a whole body, there is some research out there, but it would be great to say that there's a whole body of research that says definitively that if you have quote unquote great corporate governance, that will automatically lead to great company performance. Firstly, it's often tricky to define what exactly great corporate governance is, but there isn't a very easily provable causal link between the two things. However, there are lots of examples where companies have failed and it's subsequently been found that these are due in part down to corporate governance failings. So there are examples where perhaps there hasn't been the correct amount of oversight, And there's certainly been plenty of examples where there haven't been, where, you know, it's easy to say in retrospect to some extent, but boards haven't focused sufficiently on the long term, the threat of disruption. Business models which were appropriate for the time have subsequently changed, and what they used to do well just doesn't meet the needs of the marketplace anymore. So there's these obvious case studies where, if you like, poor corporate governance can equal poor, and it's not necessarily in the short term, but poor long-term company performance. So I think from that point of view, corporate governance is incredibly important. And ultimately, I think some of the aspects around good governance really mean that you, if you're doing it well, you are inherently minimizing risks and maximizing opportunities. So I think that's, in a nutshell, I think that's the impact of getting these things right.
Thanks, Paul. Final question from me for both Paul and Rosie before we move on to the Q&A from the audience. And I encourage anyone watching to please enter your questions into the question box. And in case we run out of time in the Q&A section, we will look to answer some of those post the webinar as well. So please don't be shy. So, you know, my final question for Paul and Rosie is, you know, what advice do you have for embedding this change in organizations?
I think from my perspective, the one key tool that we have available to us, and one thing that we definitely recommend that all our clients do, is evaluate board performance. And that can be across a number of different metrics and can be done in a number of different ways. But I think getting into that mindset immediately post IPO is a really good indicator of success, I think, because for all the work that goes into the IPO process about making sure the corporate governance framework is right for the company in the context of the, you know, the industry and all the rest of it that it's in, there can be things that need tweaking. And I think that getting into that mindset of critical reflection, really looking at what the board has done well, what the board could have done better, some of the things that are really strong processes, some of the things that can be enhanced, some of the things that we often see are around when we conduct evaluations ourselves. We often see things like, is the board skills and competencies mix right for the company? And these kind of things, we look at the board dynamics, we look at things like, as Rosie said, we look at the quality of information that's going to boards and these kind of things. And the other thing is that quite often boards can become stuck in patterns. So they can, for example, you know, to go back to the example of COVID, they can meet, you know, on a monthly basis, and that was appropriate in certain times, but it may not be appropriate in going forward. And there can be a divergence of views. And I think that the evaluation process really gives people an opportunity to air sometimes sort of quite long held grievances. So I think that it's partly a tool to assess the things you're doing well, but it's also part of a continuous improvement process as well. So that's definitely one tool that I think we really do encourage our companies to adopt.
Yeah, I think just to build on that, I think evaluations and doing it sort of not necessarily even just on a formal basis, but doing it regularly is something that we really encourage our clients to do as well. So as Paul was talking, I think there are kind of three things that come to mind for me when it comes to how you can embed these changes for the long term. I think the first is really aligning your top leaders, particularly around the kind of why they're doing this. And I think if you don't have buy-in from the top, particularly from your CEO, then, you know, the changes aren't likely to happen in the first place, and they're definitely not going to stick. The second kind of group of people I was thinking about is your kind of governance professionals, the people who are actually authoring papers, and of course your board as well. So all of them will require different messaging, and you might want to kind of communicate with them in quite different ways, but making sure they're all on board with you and part of the journey, I think, is absolutely critical to success. And then lastly, as I touched on before, using technology to help you. There is technology out there, so making sure that you're using that to really embed changes going forward.
Thanks, Rosie and Paul. Now let's move on to answering some questions from the audience. So a question we just had in is there anything stopping us from preparing our subsidiary accounts under FRS 102? It doesn't seem cost effective to prepare full IFRS accounts for the subsidiaries. Jazz, would you like to address this one?
Yeah, it's an interesting question, and the short answer is no. There is nothing stopping you preparing your subsidiary accounts under FRS 102. But as it's been touched upon in the question, is it really the most efficient and cost-effective approach? The answer for me is no. Taking this approach will mean having to convert the FRS 102 numbers at year-end to IFRS prior to consolidation, which in itself could become a timely exercise. But I understand you do not want to prepare full IFRS numbers. So what is the solution? Prepare the numbers under FRS 101. As I touched upon earlier, post-IPO, your advisors tend to disperse, and it is now down to the company to make the decision on how they prepare going forward. The difference between 101 and 102 lies in their scope and requirements. And 101 allows the entities to apply the recognition and measurement requirements of IFRS, whilst allowing reduced disclosures that would ordinarily be found in full IFRS accounts. So the answer to the question is no, there's nothing stopping you, but I wouldn't advise it, and I would advise preparing under 101.
Great, thanks, Chaz. Another question by one of the viewers is, how do you encourage reluctant boards to adopt new technology? Rosie, perhaps we'll go to you since you've mentioned technology a few times.
Yeah, I can absolutely take this one. It's funny, isn't it? You often see boards saying that they're digital first, or this is a big focus for them, and then it's not always that way in practice. So I guess it goes back to some things we touched on before. Take time to win hearts and minds. And I think different people, different individuals, different situations are going to require different messaging, different approaches to that. And it's okay if it takes time. I think particularly when it comes to technology, you do get some reluctant individuals, and that's okay. It's just sort of softly and bringing them along with you is what can win at the end of the day. Although actually, having said that, I would also say don't be afraid to take a hardline approach. I know Paul touched on COVID a couple of times, and just thinking back to that time, we also have another product called, it's a board portal. I'm sure lots of you are familiar with the board portal. And, of course, we had some users who were reluctant to download an app and to log in. But COVID hit, and no longer could they receive their board papers, as paper, and they had to do it. And actually, I think afterwards, I'd say the vast majority were very happy that they did. So sometimes these hardline approaches actually really do work, and it's the actual nudge that people need to get them over the line and to adopt the technology.
Perfect, thanks, Rosie. We also have a question about what are the corporate governance reporting challenges that new boards face, and how can these best be overcome?
I think I can have a go at that one. I mean, I think the key point is probably something that Jazz mentioned earlier, which is about forward planning, and looking forward to understand what you need to report on, who's going to do the work, who's going to sign it off, these kind of things. But I think in terms of corporate governance reporting specifically, I mean, I think there's three main challenges. I think the first is and this reflects some of what we've been talking about earlier. I think the first is about making sure that there's alignment at the board level on areas such as remuneration. What is the company's remuneration policy, not just for now, but in going forward? What are the company's principal risks? And who are your key stakeholders? Because all of that needs to be reflected, for the most part, for most PLCs, that needs to be reflected in the front end. And that really should be driven by the board. It shouldn't be driven by the company secretary drafting it. It shouldn't be, or the head of IR or whoever it is. That really shouldn't be they should be reflecting some of the board conversations rather than the other way around. So I think it's really about, again, to reflect on some of the points we've made, it's really about getting some of those things on the board agenda or on the audit committee agenda throughout the year, and making sure that the board has the chance to talk about these things. So I think that's the first challenge. The second is around data. Again, a topical area is around TCFD. We won't touch upon that on this webinar, but again, when it comes to SECR, gender pay gap reporting, TCFD, these all inherently involve the collection of a lot of data. So there needs to be, again, forward planning about, does this apply to us? If so, who's going to collect the data, who's going to do the analysis. These things can't be done very quickly. So again, it needs some good forward planning in terms of really mapping out what are the reporting requirements that you as a new PLC are subject to. And the third is around authenticity. So one of the big drives is around authenticity in reporting. The reality of the UK comply or explain regime to some extent is that companies are really incentivized to comply rather than explain. And this can often mean that disclosures in the front end can end up being kind of boilerplate because there's perceived to be less risk. If you say something that isn't too controversial, maybe no one's going to love it, but equally no one's really going to hate it either. So there is this reluctance to be anything other than boilerplate in terms of disclosure. But I think in the long term, it is really important, not just to shareholders, but to stakeholders more generally, that companies are really willing to be transparent in terms of not just the way they operate, but in terms of the way they report. So I think these are definitely some of the challenges that we've seen with new PLCs in terms of corporate governance reporting.
Thank you, Paul. Let's see. I think this question looks very interesting as well. Do you recommend preparing monthly management accounts that are IFRS compliant, or is it just the interims and year numbers that have to be IFRS compliant? I think we get a lot of questions, from companies on my side as well in the Americas that might be looking into this. So, Jazz, would you like to take this one?
Yeah, and I think actually this comes back to my original point of the FPP. The answer to the question is I'd be preparing my monthly management accounts, monthly reporting figures under IFRS, because at the end of the day, that's going to go into the board packs, and it's the board that are going to make decisions on those numbers. If you prepare the monthly numbers under UK GAAP, or if at IPO, for example, it was included in the FPP that monthly numbers were going to be prepared under IFRS, but that hasn't been filtered down to the guys that are actually preparing the pack, we could have an issue where the numbers under UK GAAP are different under IFRS. And, the one that comes to the top of my head is IFRS 16 leases. If we prepare it under IFRS, it will impact gross assets, liabilities, operating profit will likely increase as we unwind the lease liability. One of the board's KPIs might be EBITDA. That will be different under IFRS, as the cost of lease will now be a depreciation charge, which is added back for the purposes of calculating EBITDA. So yeah, I would 100% be preparing the monthly numbers under IFRS if it's possible. And it's probably also worth checking any existing bank covenants that you have. Would they require IFRS compliant numbers now, and if so, are they aware that EBITDA could be distorted with these new IFRS numbers, whereas before we might have been using UK GAAP preparation? So yeah, I would, if it's possible, I would be preparing these numbers under IFRS.
Perfect. Thanks so much, Jazz. So I actually see there's a number of other questions, but they seem to be probably a bit more detailed, and I know we're running low on time now. So maybe I would propose that we will follow up we'll probably review the questions after the webinar and, try to address them in a follow-up email to all the attendees if that works for everyone. So, thank you so much to Rosie, Paul, and Jazz for joining this webinar today and for the insightful discussion. You can visit Board Intelligence and One Advisory's marketplace profile pages at lsegissuerservices.com/marketplace. And please feel free to connect with Rosie, Paul, and Jazz via the emails, which is all under their the screens here, or also connect them with LinkedIn if you have any further questions. And we will look to follow up shortly with answers to some of the questions that you asked today, and also pre the webinar as well. And again, you can revisit this at any point using the same Spark link. But yeah, anyways, thank you for joining me in the panel, and thank you all at home for watching, and have a good rest of your day.
Thank you.
Thank you.